Hi, this is Hamiao from Group D, and we're going to present for income taxes. My group member include Belge, Justy, Pil, Eugene, and myself, Hamiao.
Good day everyone. Today our team will discuss the differences between accounting profit and taxable profit, which are crucial concepts for companies operating in Australia. Although paying income tax is a legal requirement for businesses, the actual amount paid may not match the amount that is reflected as an expense for that year in the statement of profit and loss and other comprehensive income. This presentation will explore the reasons behind this disparity as well as the implications for financial reporting and taxation. Now I am going to talk about the difference between taxable profit and accounting profit. Understanding the difference between accounting profit and taxable profit is crucial for companies to manage their finances efficiently. Accounting profit is the profit reported in a company's financial statements, which includes all revenue and expenses incurred during a period. On the other hand, taxable profit is the profit that is subject to income tax and is calculated by applying tax rules and regulations. Therefore, it is possible for a company to have accounting profit and yet still owe taxes on taxable profit. This distinction is important for tax planning purposes and for making sound business decisions. Companies need to ensure that they accurately calculate both types of profit to avoid any legal or financial complications. Accounting profit and taxable profit are two important concepts that companies need to understand. While accounting profit is the profit reported in a company's financial statements, taxable profit is the profit subject to income tax. In this presentation, we will explain the difference between accounting profit and taxable profit and why it matters for companies in Australia. Accounting profit is the profit reported in a company's financial statement, calculated by subtracting expenses from revenue. Expenses include cost of goods sold, operating expenses, depreciation, and other expenses incurred by the company during the period. Accounting profit is used to evaluate a company's financial performance and make business decisions. So the main difference between accounting profit and taxable profit lies in the fact that accounting profit is based on accounting principles, while taxable profit is determined by tax laws and regulations. While accounting profit is reported in a company's financial statements, taxable profit is used to determine the amount of income tax that a company owes to the government. To calculate taxable profit, adjustments are made to the accounting profit to account for tax laws and regulations. Therefore, understanding the distinction between these two types of profit is crucial for tax planning and financial reporting purposes.
Hello everyone. In this slide, we are going to cover the question number 2, which is, will the income tax expense for an accounting period be the same as the income tax payable at the end of that accounting period? Now, in this slide, we will first understand what is an income tax expense and income tax payable. So income tax payable is the tax which is a liability that the business has not yet paid to the applicable government. On the other hand, income tax expense is the tax charged against taxable income in the current period. If we see broadly, and we go into a deep explanation of income tax expense, then the income tax expense is basically a tax levied on the income of individuals and entities in Australia. This tax is paid by companies and individuals on their income earned in a financial year. Income tax expense is the estimated tax liability of a company, and it is the amount of tax that a company is expected to pay based on its current income and tax rates. On the other hand, if we see the income tax payable, that is the actual amount of tax due to be paid to the government. It is based on the tax liability calculated after the end of the financial year. In this slide, let's talk about the difference between income tax expense and income tax payable. The difference between income tax expense and income tax payable is caused by timing differences. These timing differences arise due to the difference in the recognition of revenue and expenses by the company and the tax authorities. For example, a company may recognize revenue in one financial year, but the tax authorities may recognize the same revenue in the following year for tax purposes. This timing difference leads to a difference between income tax expense and income tax payable. Reconciling the two amounts is essential for accurate financial reporting. It helps ensure that the financial statements accurately reflect the tax liability of the company and comply with accounting standards and regulations. Let's move on to reconciliation of income tax expense and income tax payable. The reconciliation process involves analyzing the differences between income tax expense and income tax payable and adjusting the financial statements to reflect the true tax liability of the company. During the reconciliation process, the company identifies the timing differences that have led to the difference between income tax expense and income tax payable. The company then adjusts the financial statements to reflect the true tax liability of the company. This adjustment ensures that the financial statements accurately reflect the tax liability of the company and comply with accounting standards and regulations. Reconciling income tax expense and income tax payable is important because it helps ensure accurate financial reporting, which is important for stakeholders who use financial statements to make investment and business decisions. In this slide, we talk about the income tax system in Australia. Australian government collects income tax from companies on their profits. Companies are obliged to pay income tax every year. However, the amount they actually pay may differ from the amount reported in their financial statements. Today, we will discuss the reasons behind the difference in the amount of tax payable by the companies. Thank you.
Hello everyone, my name is Baljeet Kaur. I'm going to deal with question 3, that is, why may a profitable company not have any income tax payable? First of all, we will talk about income tax. Income tax is amount that is paid by individuals and corporations based on their taxable income. It is based on the amount of taxable income. If it's higher, they have to pay high tax. If it's lower, they have to pay less tax. Here the question is, why some companies not have to pay any income tax while being profitable companies? It has many underlying reasons which we will talk about one by one. Firstly, start with tax deductions on expenses. Companies may have tax deductions on expenses such as research and development, capital expenditures, and charitable donations, which can reduce the amount of tax payable, and ultimately they have to pay less amount. Here we can take an example of mining business. In mining business, for the starting years, companies have to spend a lot of money on research and development and exploration. So that's why companies either not make any profit or they make very less profit. That's why they don't have to pay any tax. Moving ahead, some companies are maybe eligible for tax credits if they are involved in certain activities such as investing money on renewable energy, or they are undertaking eligible research and development activities. Tax credits are directly reduce the amount of tax payable. The third one is companies may also have accumulated tax losses from previous years that they can carry forward of offset future taxable income. So these were the reasons that companies that give chance companies to pay less amount of tax or not pay any tax. And besides these reasons, companies also use some strategies to reduce the tax. Here I will talk about some strategies. On this slide, we will talk about other factors influencing a company's income tax payable. Companies use many strategies to save their money. First of all, companies are engaged in aggressive tax planning strategies that are legally permitted. Secondly, some companies use tax havens. These tax havens are used by multinational companies. Multinational companies take their profit from a high tax rate country and shift it to low tax rate country. In this way, they can save their money. Singapore and Netherlands are the main low tax rate countries. One more strategy is used by the companies to save their profit and save their money, that is transfer pricing. And this strategy is also similar to tax havens. Transfer pricing refers to the transactions of goods and services between two entities owned by a single parent company. Multinational companies take advantage from this and allocate their all profit at the end of financial year to boost their earning after tax. All these strategies are adopted by multinational companies to save their money. Although these practices have been increasingly subject to government and public security in recent years, it is important to note that these practices can raise ethical and legal concerns, and companies need to assure that their tax planning strategies are compliant with rules and regulation. These were the reasons and some strategies which can be adopted by companies to save their tax. Thank you.
Hi, my name is Hamiao Zhang, so I'm gonna represent for question 4. So my topic is about will incurring loss for tax purpose will without a tax-related asset. So the first thing we need to understand what is tax-related assets. So tax-related assets are critical aspect of financial reporting, so as they represent future benefit that can offset taxable incomes. So this assets arise from differences between tax and accounting rules, and we usually know them as a deferred tax asset, which is DTA. So DTA arises from temporary difference between the carrying amount of an asset or liability on its tax base. So, or there is a difference between how the tax authority recognizes revenue and how the company does. So, for example, a company uses like 12% depreciation rate for their books and a 15% rate for their tax purpose. So it creates a difference in the final amount and generate a deferred tax asset for the company. So let's talk about how to recognize the tax-related asset in case of loss. So in some cases, incurring a loss for tax purposes can lead to the recognition of a tax-related asset in the financial statements. So this can happen through tax loss carry forward, which allows company to use their losses from one year to offset their taxable income in future years. However, this recognition of a tax-related asset is subject to specific conditions. The company must have some sufficient taxable profit in the future, and the realization of the asset must be probable, which means like a more than 15% chance. So there must be a reasonable expectation with evidence. Yeah, so let's go through further for the limitation and the disclosure requirement associated with recognition of tax-related asset. So recognizing tax-related assets now without limitation and challenges. So one significant limitation is uncertainty about future profits, which can impact the company's ability to utilize the asset fully, and therefore management must have sufficient evidence to prove that they can generate enough future profit. So furthermore, like company must disclose relevant information about tax-related asset in their financial statements. So this include the natural amount and timing of the asset's benefits, so as well as any risk associated with their realization. So disclosure is crucial and to provide investors and other stakeholders with an accurate understanding of the company's financial position, and disclosure must meet the applicable accounting standards as well.
Hello everyone, my name is Jasdeep Kaur and I'm here to discuss question number 5, that is what actions to be taken when tax rate changes. So beginning with the importance of tax rate changes. So the first point is basically tax rate changes affect companies' financial performance and its profitability. Means companies must accurately reflect changes in their tax rates in their financial statements so that they can provide stakeholders with very reliable and useful financial information. It is the it is very important for companies that they should reflect the changes in the tax rates in the financial statements whenever the tax rate changes. And if failure to do so, it will automatically lead to misleading financial statements. And obviously, misleading financial statements will lead to companies damage a company's reputation or its brand name. So moving to the next slide, what actions to be taken? The first point is when a tax rate change, companies need to update their tax calculations to reflect their new rates. Moving to the next point is when a new tax rate is enacted, not only the new tax rate be applied in calculating the current tax, but also they should be applied to the deferred amounts recognized in the prior years. Or seeking professional advice can also help to ensure compliance with the tax laws or accurate financial reporting. Now, advantages of timely action in response to tax rate changes. That what will be the advantages of timely actions whenever a tax rate changes? So there are many advantages, but we have covered only 3. So the first one is that taking timely action in response to tax rate changes provides several advantages for the companies of Australia. And the second one is it includes accurate financial reporting, like avoiding penalties and fines, and demonstrating a commitment to transparency and compliance. And the last one is, last but not the least, these advantages can enhance a company's reputation. And of course, if there will be more advantages, it will be attracting more and more investors and stakeholders towards the company. So these are the basic advantages of timely action in response to the tax rate changes. So in nutshell, or to conclude the whole PPT, is that it is very vital for Australian business to understand the differences between accounting profit and taxable profit. That is to maintain compliance with applicable requirements and give stakeholders accurate information. Business should carefully assess their tax position and make necessary adjustments to their financial statements whenever necessary. So these are the references that has been considered while preparing this PowerPoint presentation.